Hey there! Lots of people hate taxes, and it seems unfair when you make small money and still need to pay lots of taxes while some rich dudes publicly saying they don't pay any taxes. You've heard names like Robert Kiyosaki and Donald Trump openly talk about paying less in taxes, and you're probably thinking, isn't not paying taxes illegal? Here's the twist. There are two very different paths people take to pay less. One breaks the law, and one uses the law. The illegal path is tax evasion. The legal path is tax avoidance. And understanding the difference is the key to why some rich people can publicly say they pay little or even nothing while others get arrested. Let's start with tax evasion, also known as tax fraud. This is where people lie to the government about their income or hide their money so taxes don't get collected. One classic move is underreporting income. Imagine Bob buys a house from John for $700,000 with a 10% tax. That's $70,000 due. To save money, they lie and report the sale as $500,000. They only pay $50,000 in tax and pocket the $20,000 difference. It's simple, it's sneaky, and it's illegal because they lied about the actual sale price. Another evasion tactic is hiding assets. For years, Switzerland was famous as a tax haven thanks to strict privacy laws and bank secrecy. If Tom, an American, earns a lot and doesn't want to pay high taxes, he could open a Swiss bank account and not report it to the IRS. By hiding that money, he avoids taxes, which is illegal. But this changed. Many countries pressured Switzerland to share information with home tax authorities. Today, if a rich American hides money in a Swiss account, the bank would report it to the IRS and he could get arrested. Then there's false deductions. If you own a business, you can deduct expenses to reduce taxable income. That's normal. But imagine Sarah owns a pizza restaurant and earns $100,000. If the tax rate is 20%, she pays $20,000 unless she deducts expenses. She claims a $30,000 renovation, so she only pays 20% on $70,000, which is $14,000. But here's the fraud. She actually spends only $3,000, lies to the IRS, and claims the full $30,000. Now she keeps more money by inflating expenses and reducing her tax bill. That's tax evasion, illegal, risky, and it can land you in serious trouble. Now, let's talk about tax avoidance, the legal way rich people pay less. This is about using rules, deductions, credits, and loopholes the law allows. One strategy uses controlled foreign corporations, or CFCs, set up in low-tax countries. A real example is Apple. From 2009 to 2012, Apple avoided about $44 billion in taxes by using shell companies. One shell company, Apple Corporation Euro in Ireland, had no employees but was incredibly beneficial. Ireland recognizes tax residency based on management control, while the U.S. recognizes residency based on incorporation. Apple took advantage of this difference by incorporating in Ireland and managing from the U.S., avoiding tax in both places under those rules. Another legal move is transfer pricing. Picture John's company, Wee Wee Shoes Corporation, in the U.S., making $1 million. If the corporate tax rate is 35%, he'd owe $350,000. Instead, he sets up a Cayman Islands subsidiary with 0% corporate tax and transfers patents and copyrights there. The U.S. company pays $800,000 to the Cayman subsidiary for using those patents, leaving only $200,000 taxed in the U.S. at 35%, which is $70,000. No tax in the Cayman Islands, $930,000 left after taxes, and a huge tax savings. He can't bring that $800,000 back to the U.S. without taxes, but he can reinvest abroad or wait for tax reform. When the U.S. corporate tax rate dropped from 35% to 21% in 2018, that kind of change made repatriation more attractive. Quick question for you. Do you think tax avoidance is smart financial planning or unfair gaming of the system? Drop a comment with your take and which example, underreporting, Swiss accounts, CFCs, transfer pricing, or dividends, stood out to you most. Another powerful legal tactic is earning income through dividends and long-term capital gains. Warren Buffett famously pays a lower tax rate than his secretary because his income is mostly dividends and long-term gains. While a $100,000 salary might face a 22% to 24% rate, $100,000 in qualified dividends and capital gains can be taxed at just 15%. That's tax avoidance built right into the tax code. Also, don't confuse tax avoidance with tax deferral. Deferral doesn't reduce the total bill, it delays it. Think 401ks, IRAs, or real estate 1031 exchanges. You push taxes to a later date, but you still pay them eventually. If you love breaking down money myths in plain English, hit subscribe to Squirrelonomics for more videos just like this. Tax evasion is lying and hiding. Tax avoidance is using the rules. The line between them is the difference between handcuffs and a high five from your accountant. Which side of that line do you think the system encourages us to stand on?